In terms of this environment right now, this choppiness, the volatility in a market that's really kind of churned its wheels throughout 2018 so far, I think as we look at the first half of the year, or almost the first half of the year, I think it's really been this tug of war between the fundamentals and macro political risk, right? Or geopolitical risk, right? It's been this giant tug of war where in the beginning of the year, we had steel and aluminum tariffs, then we had China trade war, we had Iran nuclear, we've got China trade war and steel and aluminum tariffs again. And, basically a lot of that has masked this underlying fundamental improvement that we've seen, from our companies. But, I think a lot of that worry is behind us. I think a lot of these things are being priced or have been priced into the markets. So therefore, the second half of the year, I think, could be pretty good for valuations. Now, we had this 10% plus pullback in the beginning of the year, and that was on the heels of average hourly earnings. But as we look at that pullback, we kind of look at it and say, it's very typical. It's very normal. It's very healthy. I think when we get to the other side of this volatility, we're going to look at this pullback that we saw in January, February, the 10% decline, and say it was a very run-of-the-mill, ordinary pullback. And when you look at the history of the S&P 500 and you look at the history of the data, what you realize is two things. Number one, pullbacks happen. And number two, they tend to happen more often than people think.